outside. Call the meeting to order. Appears we have a quorum, I think. I ask the financial chairman of the House for a motion.
Yes, thank you, Mr. Chairman. I move for approval or adoption of the minutes from our last meeting on Monday, August 22nd.
For the motion of the financial chairman of the House, all in favor say aye.
Aye.
Those the same, the motion carries. All right, our presentation today is an interesting one. I mean, it's one that I think we've thought a lot about, and it's consumer sales tax base broadening, with the concept of broadening the base and reducing the rates. We're talking about the rate and so forth. We have Jared Walczak, the policy analyst from the Tax Foundation. He's got a PowerPoint presentation. He's going to take a little bit of time to explain, to get us into this subject again.
Thank you. I appreciate everyone having me here today. I will try not to make this take too much time, and I'm happy to take questions either during or after, however the chair would prefer, but happy to have this as a conversation. Sales taxes are in many ways designed as a legacy tax system because they, outside of property taxes, are one of our oldest taxes and therefore often bear the hallmarks of when they were designed, a time when collections was much more difficult, where keeping track of transactions was more challenging for states, where compliance costs would be higher, and therefore states generally went with what was arguably the easiest approach, just looking at retail transactions on goods, and in many cases only retail transactions on the most obvious goods. West Virginia is arguably the first state to have a general sales tax. Excise taxes have existed arguably from time immemorial. We see them in the 12th century. We see excise taxes. We see some things that look like them in millennia BC. But in the United States, the idea of a general sales tax arguably begins in West Virginia in 1921, then disappears, then reemerges in the 1930s when a lot of states are adopting sales taxes. And it looks like, if we could go to the first slide perhaps. We have a bit of a slide issue if the clicker's not working today. And the sales tax looks like what you would expect in all states, not just West Virginia. It was constructed at that time. In fact, many of the first sales taxes were literally on dry goods. We don't have just dry goods sales taxes anymore, but sometimes our base still seems that way. We have structures that reflect the economy and the administrative limitations, and this is really why most services are not in the sales tax base. There's really no evidence that anyone, when sales taxes were being created, argued for the exclusion of services as a principled or policy-minded decision. It was simply that services were harder to source, services were a much smaller portion of the total base. They just weren't that significant, and it was easier to exclude them. Of course, we have seen a dramatic change. Just since the last 50 years, we've seen the national economy go from a 2/3 goods-based economy to a 2/3 service-based economy. And what's amazing is we're not stopping. Presumably there is some upper bound here, but we have not reached it yet. We become more service-oriented every year, and as our economy is increasingly global, the advantage the United States has is really in capital and capital-intensive services. Recently came across a number that I thought was very telling. In the United States, the average, the median employee has $118,000 worth of capital behind him. There are countries where that's $2,000 or $3,000. This is what we are. We're a service-oriented, capital-intensive economy, and we still have a sales tax that assumes that we are largely a goods-based economy, one that just produces and sells the sort of retail goods. That's not who we are. The sales tax is not particularly reflective of where we are. If we could flip to the next slide. Beyond that, so we already have this narrowed base because services are generally not included in sales tax bases. We also have policy determinations the states have made for a variety of reasons. West Virginia, for instance, excludes food for home consumption, your sort of grocery exemption. And this hasn't always been the case, but a lot of states, most states, have adopted grocery exemptions to deal with regressivity, to try to make the sales tax a little less regressive, to provide an advantage to lower income consumers. arguably not a particularly targeted approach to this, but nonetheless addressing a policy concern. Prescription drugs are often exempted for similar reasons, so we see these base narrowing policy determinations. The result, though, is that the sales tax base is narrow. In fact, in West Virginia, my best attempt to try to determine what the base is as a percentage of personal consumption is that it's about 29% of personal consumption. Now, it applies to some things that aren't personal consumption. You have your business inputs that are in the base, businesses making these purchases as institutions. But if we're just looking at personal consumption, about 29%. And there are different measures of this. There's an economist at Indiana University that looks at it as a percentage of overall personal income. It's a different measure, but most states are in the 30% range. And of course, an ideal structured sales tax is going to be significantly higher. It's not going to be 100% of personal income because we don't spend everything on consumption, but we spend more than 30% of personal income on consumption. So again, sales tax that's increasingly narrow. We do, and if I could flip another slide, we do talk though about some exemptions that are done for structural purposes, and this is largely the exclusion of business inputs. 45 states levy a general sales tax. Of those, 42 make a substantial effort to exempt business inputs. This does not mean they exempt all business inputs. In fact, no state achieves that, but 42 of the 45 make a very substantial effort to keep as many business inputs as possible out of the base. Why do they do this? It's not because they feel the business shouldn't be taxed. It really has nothing to do with that. It's simply to avoid what's known as tax pyramiding, where when the final transaction takes place, the same tax is embedded multiple times along the production process. Again, every state has some business inputs in the base. West Virginia does, every state does. If sales tax base broadening is on the table, I would strongly encourage it to be designed in a way that does not increase that ratio. You're probably not going to get rid of every input that's in there, but that you don't try to build primarily on business inputs and instead look at those final consumer transactions to avoid having prices that bake this in. So sometimes you hear, well, wait a minute, why would I tax individuals and not businesses? Really, you're taxing individuals either way. The question is, does the individual pay it once, or is it already being embedded into the price multiple times before the good or service even gets to them? And of course, a broader base, if you're able to do this, permits lower rates. It also shifts incidence towards higher income individuals, because you do hear this argument that sales tax is regressive. And the rationale is pretty simple here. There are different measures of regressivity and progressivity, but one of these is what percentage of personal income is associated with paying any tax. And of course, lower income individuals are going to spend more of their overall income on consumption goods, on staples, because you're not going to scale your need for groceries as much in terms of income as you are other purchases. You will scale services because services tend to shift more up the income ladder. Consumption of services is much more of a middle and upper income purchase and activity. So broadening the sales tax base actually has the effect of making the tax more progressive. It also, I would argue, just makes the tax more equitable because there really, again, is not a good economic argument as to why some of these things should be in the base and some out. So if you broaden the sales tax base, use that additional revenue or some portion of it to pay down a rate reduction overall, you're actually making the tax more progressive, you're making it more neutral, which neutrality is, I think, something that the committee should certainly be looking at as a goal in any sort of tax reform, sales tax, or any tax policy, because your tax policy ideally shouldn't be picking winners and losers or determining who benefits. It should be as equally and neutrally applied as possible so the market can make those decisions. And again, it's a lower tax rate on things that are already in the base. We could flip to the next slide again. I want to give you the tough part of this because sales tax base broadening has several difficulties, several challenges. One really big one is the revenue projections. And you will hear this from any revenue officer in any state. It is harder to project sales tax base broadening revenues than it is most other taxes. And why? I think on a static basis, if you were to cut or raise individual income taxes or corporate income taxes by 1%, You could do a back of the envelope calculation just on the current rates and collections and figure that out. Now there's some dynamic effects, there are some changes, it's not purely that initial static score, but you have a really good sense of what raising or lowering a tax by 1% does. You would on sales tax too. When we're talking about taxing something that's currently on the base, it's something we're currently not necessarily calculating or tracking particularly well. Some better than others. So things that would typically be in the base, that are defined as in the base, but then the code specifically exempts them, there's often better tracking of that. So if you look at the sales tax expenditure report that West Virginia has, which is a very good report, better than I see in a lot of states, when you look at that list, most of what it focuses on are things that would inherently be in the base if it wasn't for a policy determination. So essentially tax goods, groceries would be in there, except the legislature said they're not. So we have groceries number. Prescription drugs. They do this with personal services as well, and they do it with some professional services. You'll see, though, that the list doesn't cover everything that could be covered. There's just some things that they're inherently exempt currently, and the report doesn't track that, even though it might be the desire of the committee and the legislature to tax things that aren't currently in the report. There's also a challenge in how reports quantify this. Again, there's some uncertainty as to the numbers because we're not necessarily tracking these things very closely. There's also the potential to double count. I'll give an example I gave to some members previously, so some of you might be hearing it a second time, but let's say you decide to tax prescription drugs. Now this is a big ask, but let's just say for sake of argument we're going to tax that. Now if you were looking at your options in a sales tax expenditure report, you're going to see the prescription drug amount. You're also going to see the nonprofit exemption, nonprofit purchasers. If for some reason the state decided to tackle both of those at one time, you would not actually be able to add all the revenue from item 1 to all the revenue from item 2, because of course hospitals are a nonprofit purchaser that purchases an awful lot of prescription drugs, and you'd be double counting if you simply added those things together. If you looked at all prescription drug purchases, you might also be capturing, say, Department of Corrections purchases. You can't tax those. So, you have to be careful that you're limiting these to the sort of consumption you could actually tax, and that you're not double counting in multiple categories that might have overlap. In projections that I put together, you do all have a sheet in here of a couple of different menu of options that I put together. I went with an approach based on the BEA's personal consumption expenditures, scaling that based on their understandings of West Virginia's economy and the expenditures on the personal level in each of these categories. So this inherently excludes business inputs. There are categories here that can be both business and individual purchases, but this only looks at the revenue associated with the personal consumption side of it, because that's the definition of a personal consumption expenditure. If you were to design a system that exempted the business side, this is the revenue you'd get. If you didn't exclude the business inputs, then on some of these categories you'd actually see more revenue. But again, recommend that not be the approach. Obviously, there is a margin of error in any of these calculations because, again, we're using data sources that weren't designed specifically to track exactly how many purchases subject to sales tax exist. This is why it's wise to take a conservative approach with sales tax base broadening. If you look at a projection, it's probably worth, if you're going to buy down a rate, buy it down a little less than the projections might indicate, whether it's my projections or the projections you get from Department of Revenue. It's an issue that has to be addressed, and something that I think is very valuable there is using tax triggers. If we go to the next slide. Tax triggers are increasingly popular, and West Virginia is sort of a pioneer on this. Not the first public trigger, but one of the first to use them to reduce the rate of a major tax. The corporate income tax was, of course, reduced using triggers. There are lots of different ways that you can design triggers. There are better and worse ways. I actually recently put out a paper on this, and if anyone wants to read a little more about triggers, reach out to me. I'd be glad to send you a copy. But triggers can help ensure revenue availability and stability during the pendency of a tax change. Sometimes this is to phase in a tax over multiple years, say as revenues just grow over time. As the economy of the state grows, then part of the additional revenue is going to go towards tax relief. Triggers can also be used, though, essentially as a diagnostic, an if and then sort of scenario. So let's say, hypothetically, that you decided to adopt a base broadening plan that projections say would allow you to reduce the rate from 6% to 5%. One conservative way of approaching this would be to immediately reduce the rate to 5.5% and have a trigger that in 1 year, after 1 year worth of revenue, evaluates what the revenue actually was that was brought in, and then allows the rate to be further reduced in a subsequent year to reflect that reality. Maybe it gets it to 5.25, maybe it gets it to 5, maybe even goes lower. Maybe your projections were already conservative, but because there is an error bar on sales tax-based broadening that's broader than you have in some other taxes, I think a trigger is a very responsible way to make sure that you actually got the projections right, or to adjust your rate based on real-world data as you get it for a year. And you don't need to phase this in, because it really is just a question, did we get it right or not? And once you determine what the revenue levels are, you can adjust the rate accordingly. This also provides you an option. I know that currently West Virginia is facing a budget shortfall, and whether we're looking at this for this year or the next, if you say go to 5.5 and then you determine that that's a little extra revenue, the state can decide what to do with that, whether to dedicate it. You want it to be a one-time expenditure if you're doing anything, because this isn't a sustained revenue source, but put it aside your rainy day fund and the pensions. There are opportunities perhaps if there is that 1 year revenue need as well, as you're phasing this in. West Virginia's experience with tax triggers, I think, suggests that this is very possible here. About a dozen states have used triggers over the last few years, and it's becoming more and more common. I expect that moving forward, most major tax reforms that states adopt will probably have triggers. We're not talking every tweak you do to the tax system, but if you're looking at major regular-based changes, I think states are increasingly looking at triggers to do that. Lots of ways you can do that. You can be looking at, some states use projections. Some states use years worth of revenue. I tend to look at this ideally as seeing what revenue actually comes in, not projections, because this is the point of a trigger. If you're just using projections, you could just go by the projections you have and make the change immediately. One very important thing if you're using triggers in other areas is to make sure you're looking at meaningful growth, not just year over year. Take say, a trigger that phases in over 3 or 4 years. And in year 2, you hit a recession. And of course, collections just go down. Regardless of what you're doing on taxes, collections go down. Year 3, your economy bounds back exactly to where it was previously. And maybe you saw 2 or 3% growth as it rebounded. Is that growth? If you design it just year over year, you had growth and you hit a trigger. If you say, no, we have a baseline, we need to grow over some amount or have some goal or target, then you say, no, that probably wasn't a trigger. We don't actually implement the next stage. Again, not as important if you're looking at a 1 year, just did we actually achieve the revenue targets, but if you're thinking of triggers more broadly on tax reform, structuring them to make sure you're seeing real and meaningful sustained growth is, after all, the point of a trigger. So let's talk a little about a couple of scenarios. We go to the next slide. You do have a piece of paper in all of your packets that I can't present on the slide, so I'll just point you to this. This is 4 possible scenarios. Looking at sales tax-based broadening, we've got a column now, this is the status quo. Check is in, obviously. A few of them say 5 cents because you do have some things, maybe your motor vehicle taxes, where it's a 5% and a 6% rate. So that has been reflected in my analysis. And looking at what sort of revenue would be associated with broadening the base. Good news and bad news. Good news, there's a lot of revenue that you could gain by broadening the base that could be used to pay down rate reduction in sales tax or other taxes. Bad news is it's not necessarily a lot of low-hanging fruit. So, the first category, you see, that category A, and it looks like the revenue projections might have gone off the page a little here. No, you should see them on the first side, didn't show them on both sides. But, the first one, basically I'm looking at, what happens if we put in the personal services that are not currently in the base. You have some of them in, some of them out, so put those in. You tax the vast majority of durable goods, but there's a few categories you don't. So put those in the base, bring up the motor vehicle tax to the same rate, which if you're lowering to 5, it's still going to be 5, but bring it to the exact same rate. Don't scale it down lower than everything else. Bring in water and sewage. You do some utilities, you don't do water and sewage. Sort of miscellaneous stuff in the motor vehicle rental. And and you're looking at $75 million, which is not nothing. This is revenue. This can allow you to reduce the rate if you actually achieve that to 5.65%. So you couldn't make a 0.5% on that. You'd be less than that, and where you really get the growth, obviously, is when you start looking at broader categories. It's really challenging, but if you're looking at putting groceries in the base, that's worth 175 to 225 million, depending on the estimate. That one's a broad range, but there's a lot of revenue associated with that. Prescription drugs. This is one where, because of different ways that I calculate versus how the state calculates this based on business inputs, there's differences. I calculate that as about $110 million in prescription drugs. The state calculates it at 180, so the state has a much higher revenue figure associated with this, but I believe that includes taxes on a lot of institutional purchases that probably wouldn't actually be taxed. If you tax every transaction involving prescription drugs, you might get to 180, but you probably wouldn't. So I assumed 110. Your sort of professional services consumed by individuals, insurance, financial, accounting, tax preparation. That, my estimate is 155 million on that. The really big numbers come from healthcare, education and healthcare. If you were to tax those, the private education and healthcare, $630 million, and like 575 of that is healthcare. Those are the big categories. If you were looking to do something bold, if you were looking to lower rates, I've been asked, what would it take to get to 3.5%, to 3%, to cut our rate in half? Well, you have option D. Option D cuts your rate in half. And I'll jump to that in a little, but you have these ranges. Some of them are perhaps easier than others. Some of them are very difficult. So again, A went through, that one is worth, about $75 million. We can go to B on here. This one's worth $340 million. You add in groceries. You add in those professional services by end users, and you add in financial service charges and fees. Now, we're not talking about, say, the value of a financial account. We're not talking about some sort of tax on your investment, but if you're paying an investment fee, or if you are charged some sort of fee or commission, if you put that into the tax rate. Now you're looking at 340 million, revenue neutral rate is under 5%, and my estimate is 4.75. Again, recognizing there is some margin of error here. Looking at option C, which is the next slide, this one we get big. We get to 910 million, 3.5% rate, and this is where we start throwing in the healthcare. Prescription drugs, outpatient healthcare services, and proprietary hospitals. I'm still excluding nonprofit and government hospitals. Insurance, and this is a difficult call because insurance is subject to other taxes. In West Virginia and every other state, you have premium taxes. You have other taxes that are imposed on insurance, gross receipt style taxes. There's a question. Do you put in the sales tax base too? Arguably, the optimal structure is, yes, it should be subject to sales tax, but it should probably have lower premium taxes. Not necessarily none, but it should be lower because otherwise you have a very substantial tax on insurance. But this is sort of outside the scope of the analysis right here, including insurance here, including telecommunications services and deliveries. 910 million. Now you're starting to get the really large rate reduction of 3.5%. Option D is the next slide, and this is the largest that I went. This doubles your sales tax base, $1.3 billion in estimated revenue, adding the remaining hospitals, nonprofit and governmental hospitals, adding nursing homes, adding the public transportation that you'd be allowed to tax. So when you start getting into interstate activities, there are limitations on what you can and cannot tax. I'm not assuming you would tax anything that is constitutionally suspect. So I took a pretty modest conservative estimate of what you get on taxing from the public transportation, and then taxing sort of the residuals of education that I left out of the previous category. When I said tax education, I didn't put in, say, like school lunches, but now throw the rest of it in, and that's what it takes to get essentially cutting your rate in half. Cutting your rate in half is therefore very, very difficult. And there are 3 states that basically do this, that have a sales tax base that is at least as broad as this option D. That's South Dakota, New Mexico, and Hawaii, all of which had their sales taxes like this effectively from the start. They have very broad-based sales taxes that include the vast majority of transactions. They also include more business inputs than they should, but they have these very broad bases and therefore have pretty low rates. Some of them very low, and some of them use relatively low rates to offset lower taxes elsewhere. South Dakota, for instance, doesn't have individual or corporate income taxes. They have a 4.5% sales tax. They generate an awful lot of money on a sales tax at 4.5%. They also have, they're pretty low government states, so they don't need as much revenue as some states choose, but they're generating an enormous amount from that sales tax because it's more than twice as broad as yours is. So there are options here, and an option a state might choose might be somewhere in between. I don't present these as the four options. I present them as sort of representing points along a range, depending on what the appetite of the legislature is, and if it would be in this direction. I do contend that this is an important issue to address for a number of reasons. One, you will see continued erosion. If you look at the trends in taxation, corporate income taxes are being cut in a lot of states. 15 states have cut corporate income taxes since 2008. 15 states have also cut individual income taxes since 2008. Not the same 15 states, it just happens that the number is 15 on both. You don't see that trend on sales taxes. Sales taxes are increasing. Just in the last 12 months, Louisiana, South Dakota, and Kansas have raised sales taxes. Kansas is a little unique. It really doesn't have to do with broader issues. It's addressing the crisis they created for themselves. But why do sales taxes raise their rates while other taxes don't? And this is not just the case in the last year. This is the case in the last few decades. And it's because just to get the same amount of revenue, you have to keep hiking the rate because the base gets smaller every single year. You might not notice it year over year, but you'll notice it decade over decade. And states are therefore constantly adjusting these rates upward. And this is not optimal. We have this ever narrowing base with ever higher rates. This is the opposite of what we look for in tax policy, where we've got those broad bases and low rates. We also look at sales taxes as taxes that honestly are economically competitive taxes. Whatever you tax, you get less of. Now, this is on the margin. This doesn't mean you're going to obliterate something because you tax it. We need taxes. But anything that you make more costly, we are going to shift the demand curve somewhat. And really, you can, broadly speaking, tax just a handful of things. You can tax capital investment and accumulation. You can tax labor, or you can tax consumption. And any economist will tell you that taxing consumption, making consumption relatively more expensive compared to, say, making capital or labor more expensive, is going to be less economically harmful than the others. This is why we see more of a dynamic effect associated with tax cuts on capital than we do on consumption. So if we have a sales tax base that keeps getting narrower, we do nothing about it, then without the legislature ever taking any action, the tax burden of the state overall is shifting more and more towards capital and labor and away from consumption. That's not arguably where the state should be. Consumption is a very important base for the state, and it should not be becoming a smaller percentage of the overall picture in your budget. And you can you can address both, say that, one of the reasons why consumption often is in the broader category is the regressivity concern. And again, you can address this with service expansion. You can actually make it a more progressive tax as you also focus more on consumption, which has the economic benefits. So I think this is something that states are increasingly looking to tackle. In fact, within the last year or so, we've had budgets by governors in Illinois, Pennsylvania, and Maine that included expansion to very large number of services. In Pennsylvania and Maine, it was basically almost all final consumer transactions, goods and services. In Illinois, the governor had a list of 32 services, which would have been very substantial. It would have been, it wouldn't have been all, but it would have been a very substantial increase. These states have been unable to move these forward. Interestingly, in Pennsylvania and Maine, there is agreement that this needs to be done across party lines, but governors who have been unable to work with the legislature to accomplish this. In Illinois, they can't even pass a budget in Illinois, so I can't tell you what Illinois would do. But there is increasingly this tendency for states to look at this as a good option, whether they're looking to raise revenue as one of the most economically efficient ways if you are going to raise revenue, or if you're looking to offset a cut somewhere else as probably the best way to buy down a rate in another tax, or to buy down the rate of the sales tax and make the code overall more neutral and more efficient and more geared towards the 21st century. States are realizing they can't let the base erode forever. And we haven't seen the dam break yet, and states go all out and sort of adopt these option Ds. We are seeing states chipping away every year. Every year, if you ever look at the Federation of Tax Administrators list of sales tax bases, watch the trend, pull a couple years worth, and you're going to see more checkboxes every year across the states as they add more and more services to their base. But it's been incremental. We haven't seen states pull the trigger on going to something like a C or D. It's going to happen. I can't tell you when. I can't tell you who will be first to do it. I do think that once it happens, you're going to see the floodgates open. It might even involve agreements with states where they implement when other states do, try to do it in concert. But every year, states are doing things a little like option A, or at least borrowing some from an option B, where they're expanding that base to try to get ahead of things, to say it's better to broaden the base than it is to have to raise the rate, or to raise the rate on something else, or create a new tax. That this is a neutral tax reform that has a lot of potential. If we could go to the next slide, and I'll try to wrap things up pretty quickly and then take questions. But anytime I talk tax reform anywhere, I get asked about Kansas. So I just want to address, what did Kansas do? Because frankly, Kansas did a lot of things wrong, and you don't have to be, and you should never be Kansas in doing tax reform. So first thing that Kansas did was bifurcate a bill that initially included very large tax cuts, very, very large tax cuts, and very substantial spending cuts. And they split the bill in half, and they passed the tax cuts, and they rejected the spending cuts. And amazingly, the governor signed it. The governor went forward with a tax plan that included more than $1 billion in tax cuts first year, and no way of paying for it. And that wasn't the original plan, but new rhetoric formed around it in terms of growth paying for the increase. I wish I could tell you that happens. There are dynamic effects of tax reform. A better tax code creates growth. It provides more, we can have more capital accumulation. We can have more investment. We can bring people into the states. There's lots of positive benefits of improving your tax structure. And if I didn't believe that growth was associated with this, I wouldn't be here. If legislatures didn't believe that taxes affected economic decision making, you'd never have incentives on the books, because why would you offer tax incentives if taxes didn't actually affect economic decision making? But that doesn't mean that you get one-to-one revenue. If you cut taxes by $1 billion, you don't grow your economy sufficiently that you would get an additional $1 billion in revenue. And no one who tells you that, you can't say that and be taken seriously in most rooms. That requires massive growth. Now, different taxes have different effects. So the more capital-oriented they are, the more dynamic effect you'd expect. The more consumption-oriented they are, the less dynamic effect. So, if you were to cut the sales tax, you would get less of a dynamic effect than if you cut the corporate tax, or if you cut a tax on, say, capital accumulation, or something like the throwback rule, or something like that. Throwout, rather. I apologize. But the dynamic effects are not going to replace every dollar of lost revenue. It might be a question of, do we lose 80 cents on every dollar we cut rather than $1? Can we get to 70? It's not, can we actually make it neutral or even grow? Secondly, they created what was called the pass-through exemption, where they determined that income from pass-through businesses, these are your S-corps, your partnerships, your LLCs, all of these businesses, many of them small, but not all, that this income would not be subject to the individual income tax. Now, of course, it's not subject to the corporate income tax. That's only on C corporations. C corporations, in some ways, of course, pay twice. They pay at the corporate level, and then people pay a second time when there's wages and dividends and, whenever the money is distributed, you have two layers of taxation. Pass-throughs, the great advantages, there's only one level of taxation. The disadvantage is that you don't have the opportunity to have retained earnings. So this is the trade-off that you make as one of those companies. What Kansas did is say, well, you don't pay the individual income tax either. So now, if you have one of those companies and you have an ownership stake, anything outside of wages that you're paying to yourself is literally income tax-free, corporate or individual. And that creates a massive hole, and that makes very little sense. It's great to eliminate double taxation, it's great to lower people's rates, saying fairly arbitrarily, if you pay yourself essentially through the earnings of an LLC, an S-corp, or a partnership, and not wages, then you don't pay income taxes of any sort. this is a very curious tax policy. And it also creates things where, say, you're a dentist. You don't pay income taxes. Now, you pay your dental hygienist, and he or she pays income taxes, and that's wage income, but you don't pay income taxes. I don't understand why that would be a desired outcome of tax policy, but it also just blew a hole in their budget. And they didn't even anticipate there'd be any arbitrage. And I'm going to tell you, if you create a category where people pay no income taxes, they will find ways to be LLCs, even though they used to be wage earners. They will find ways to go from a C Corp to an S Corp. Not everyone can do it. There are federal laws and rules about how you define this. Everyone can't become an LLC. But you better believe that people will be very creative in finding ways to restructure at least part of their income to take advantage of not having any tax on it. So Kansas did this. They also just did a really bad job of budgeting. For instance, they completely forgot about farms. I don't know how you can be Kansas and forget that farms exist, but their analysis did not include farms. So of course, farms are very rarely C corporations, so they assumed that all farm revenue would just remain, of course, almost all of it vanished. So very, very poor calculations, and then extremely optimistic projections ever since then about what the revenue can be. Now, I don't have any insights onto why and whether there's been any pressure or if it's just that they have very optimistic assumptions, but as everyone else looks at them and says, well, clearly you're going to miss this revenue target, they continually, every quarter, have really optimistic revenue targets, and every year they miss it. So don't do any of these things. I mean, don't carve huge holes in your budgets. If anything, you should be looking at broader neutral bases, which is the theme on the sales tax, but really should be the theme on any tax, not having massive exemptions, especially arbitrary exemptions. Any sort of reductions you would make in rate, what you're paid for. And sometimes your paid for can be a genuine cut. I mean, sometimes the state is looking and actually says, we want to get by on less revenue, we believe that people need a tax cut. But know where it's coming from. Kansas just said, we're going to make it up somehow. You don't make up $1 billion tax cut. So when I talk about sales tax reform, these are revenue neutral options. And again, I talk about using triggers to make sure they're revenue neutral, that you address the uncertainty that may be inherent in sales tax base broadening, to make sure the revenue is there to see what actually comes in before you continue on with a further rate reduction. Most the problems that Kansas experienced can be addressed just by the sort of good decision making that state legislatures make every day. And this has been one of the grave frustrations of Kansas, because there's so many success stories on positive tax reform. And then there's Kansas that just violated all of the basic precepts of what we think that legislatures usually do when they are looking at budgetary and revenue issues. And they have become the poster child, unfortunately, in some circles for tax reform. If you do tax reform, you'll be Kansas. You won't be, because I trust that West Virginia would not do these things. You won't arbitrarily carve out your base with a massive new hole for random income. You won't do $1 billion in non-offset cuts. So don't do those things and you won't be Kansas. I think it's really as simple as that. But sometimes bad ideas don't go away. So I mentioned the pass-through exemption. We saw a presidential plan come out just a couple of days ago. It didn't have pass-through exemption, but it had a differential treatment of pass-through income at a 15% rate. So the average wage earner would still pay at the graduated rate schedule, which would go up on that plan up to 33%. But if you could schedule it as pass-through income, it would all be at 15%. Again, you might like tax cuts. That's pretty arbitrary. That ends up creating lots of arbitrage opportunities, attempts to reclassify your income. Goal of good tax policy should be as neutral as possible, because the tax code, to the greatest extent possible, should not change people's decision making. When tax codes are making your economic decisions and your business decisions for you, there's a problem, there's a flaw that needs to be addressed. And right now, the sales tax does that a bit, because it arguably arbitrarily excludes a lot of things. Some of them are policy decisions, many of them are just based on when the tax was imposed. But there's this opportunity. Address the erosion, do the base broadening, maybe see some rate reduction, phase it in with triggers to assure the revenue needs. And I think that you can have a much better structured tax code that will grow with the state's economy, that will keep ahead of the changes that you're experiencing, and will avoid putting pressure on other taxes, especially other taxes that you really don't want to see upward pressure on as we go forward. I'd be glad to take questions. And also happy at any time, if any members of the committee would want to know, well, what if I come up with a different scenario? What if I wanted to add, make this sales tax base? Contact me afterwards. I'll be glad to run those numbers for you.
All right, thank you very much. We've seen 4 different ideas. Are there questions of our presenter? Okay,
Thank you, Mr. Chairman. Jared, thanks for your presentation. In this presentation, you talk about the revenue neutral rate for each of these, and you and I were talking a little bit beforehand. Do you have recommendations for other taxes if we were to broaden the sales tax base? Are there other taxes that, I know in other meetings we talked a lot about the success that other states have seen with lowering the income tax rate, for example. Are there other taxes you would recommend rather than just making a revenue neutral rate that would be beneficial for West Virginia?
I will defer to the legislature on how to use revenue, but I will make a comment here that, again, as mentioned, different types of taxes raise costs for different things in different sectors of the economy. And you do see the greatest return in terms of economic growth when you are reducing taxes that fall heavily on capital accumulation. So whether that be, say, tangible personal property taxes on business or gross receipts taxes like you have at the local level, which are not purely it's a tax essentially on your accumulated, it's not accumulated wealth, but it's, because it's not tied to a net, it is more capital oriented and makes it more difficult for economic growth to take place. You see more growth associated with reducing rates or incidence in these areas. Next would be individual income taxes, because this is essentially a tax on labor. And all of these things are at the margin. Reducing a tax is not going to, say, eliminate unemployment in a state. But on the margin, people will choose to work more, and you will see higher productivity when income taxes are lower. It can have some migration effects. These can be overstated. I'm not going to just sit here and tell you that everyone will rush to West Virginia if your income tax was lower. But we do see that businesses and individuals respond to taxes. Taxes are not the only thing they respond to. They care about they care about amenities. They care about standard of living, cost of living, educated workforce, infrastructure. Lots of different things go into decisions that both people and businesses make. But we live in a time when both capital and labor are extremely mobile. My grandparents, from the day they got out of high school to the day they retired, they worked the same job, same field, same steel mill, never moved. My generation, probably the average person I grew up with will have 8, 10 jobs in 3 or 4 different states. People are mobile. Businesses are mobile. Capital is more mobile, and states need to be responsive to this, and taxes can have a significant impact. And while they're not perhaps the biggest determiner of where people or companies or capital move, it's the one that is the most within the power of the state legislature, especially in terms of immediate impact. You can't change where you're located. You can make changes on things like infrastructure. You can make changes that address education. You can't change, a lot of the intangibles the states compete on. You can definitely and very quickly change taxes. So again, you get that bigger bang for your buck on sort of the capital-intensive taxes. States obviously make determinations on what they want to tax and what levels on things other than just the greatest bang for their buck. If we were just doing that, then states would probably only have consumption and property taxes, and no state does that, in part because there are concerns about incidence of taxation, collection, sort of diversifying the tax base in the same way that a person diversifies their portfolio individually. But there's certainly an argument for prioritizations, based on where there is economic growth. But there are a variety of different ways the legislature could look at this. Certainly, you can be competitive by lowering a sales tax rate. You can be competitive by lowering an individual income tax rate. I think that there are enough opportunities in West Virginia that, while there may be prioritizations that members may make, there are a lot of good things you could do.
Thank you.
All right, any further questions? Yes.
Thank you, Mr. Chairman. Jared, thanks for a great presentation. One takeaway I got from your presentation was don't be Kansas. Would you be able to elaborate for maybe a couple of minutes on maybe a success story or two that we could look at as a model from your perspective as maybe somebody that's done this right?
Absolutely, I appreciate that opportunity. It's nice to talk about the positive side of this. There are a lot of states that have done good things on tax policy, but I would point you quickly to 3 that have done really broad-based tax reform in recent years, and those would be North Carolina, Indiana, and Utah. These 3 states really overhauled their tax system, and I also like these examples because these are states that in some ways are fairly typical states with fairly typical economies, and they have all of the major taxes. Because we can look at states that say forego corporate individual income taxes, like Wyoming, and say, oh yeah, that's great, I mean, wouldn't we love to not have a corporate or individual income tax? And maybe you could think of that if you were Wyoming and you had the sort of oil revenue and the severance taxes that they have. And of course you have economic, natural resources here, but you can't do that. West Virginia cannot follow the Wyoming model or the Alaska model, but you can follow the Indiana model or the North Carolina or the Utah model. All of these states have more typical economies, and they have been looking at making their tax code substantially more neutral, more growth-oriented. North Carolina, I really think one thing, legislators just woke up and realized they had a crisis. And of course, they also had a party change for the first time since Reconstruction. They had Republicans in both the legislature and the governor's mansion, and the Republicans had run on, we're going to do something on taxes. And then it was just what is that? Indiana did not have that. They had a mixed party system, and were able to accomplish that in a very bipartisan way, which I think is a valuable example as well. But in these states, like North Carolina, had an economy that no longer reflected its tax code. They had very high rates. Both corporate and individual income taxes were fairly high. Corporate was particularly high. And the way the system always worked was that the industries that were significant in the state, like textiles and manufacturing generally, and agriculture, particularly tobacco, were favored. They had lots of incentives. So it was really cheap to do business as a tobacco grower or as a textile manufacturer. But if you were something else, it wasn't so great. And at some point, those were no longer the growth industries. In fact, they were barely the industries in North Carolina. And they weren't competitive for other businesses that they might try to attract. So they decided on a pretty radical overhaul in some respects. And they actually had flat taxes, both flat individual and corporate rates, and they've been lowering them. They cut them immediately, both individual and corporate rates, and then they used triggers as revenue grew to phase in further reductions. So their initial effort was meant to be revenue negative. They decided on a package of tax cuts that would cost, but they cut expenditures along with predicted revenue losses from tax cuts. They were very conservative in their projections of what they were doing. In fact, they beat all expectations. They ran a surplus. They've run one every year. In fact, now their revenue is higher than it was when they began the tax cuts a couple of years ago. Doesn't mean they didn't get a dip. They intentionally cut taxes, but they have grown very rapidly. They've grown faster than their peer states. And they've been very neutral. They paid for some of the tax changes by eliminating a lot of the exemptions and incentives in the corporate income tax, by flattening the individual income tax, by getting rid of some of the deductions that used to exist. They broadened their sales tax base. They didn't go to, say, something like an option C or D, but they did something maybe between an A and B, as a way to pay for reductions in other taxes. And they are on track next year to be down to 3% on the corporate income tax rate. They are under 5.5% on the individual income tax rate and will continue to decline a little further. They have a competitive sales tax rate with a broader base than they used to have. And they're addressing a couple of other tax issues as well. And they're now one of the more competitive tax codes in the nation. Indiana, similar. They didn't have quite as much of a crisis that they were addressing, but they saw an opportunity to be more competitive, and they continually lower both corporate and individual rates. They're going to be down to 3.23, I believe, on the individual income tax next year. They're phased in. Been lowering the corporate income tax. They addressed tangible personal property taxes. They used to have those. They don't have them anymore. They offset that with revenues elsewhere. They did a bit of sales tax base broadening. They addressed some UI issues, I believe. They covered a bit of everything. Utah did the same thing. And then you have states that have taken a slightly more measured approach. New York, a state that we don't always associate with tax reform, decided that while they're still going to be a very high tax state, they needed to address their corporate tax structure. There were actually 4 different ways that you would have to calculate your corporate income tax, and then you pay the highest of the 4. So incredibly high compliance costs, a lot of confusion, a lot of errors associated with this. They also had, they had personal property taxes, they had throwback rule, they had franchise tax, just lots of issues. So they're phasing down the franchise tax. There still has a few more years to go, but they're eliminating the franchise tax. They eliminated all the alternative tax schedules to make it a lot simpler. They've reduced the corporate income tax rate, and they're broadening their net operating loss carrybacks and carry forwards to make them identical with sort of the national average. A lot of positive reforms, and they're still a high tax state. It's not that it's cheap to do business in New York, but people are willing to pay a lot to be in New York because it's a global capital and people want to be there, and there are a lot of advantages, and they've found a way without revenue losses actually. They offset almost all of this to make the structure an awful lot better. And they're very pleased with the results, and Governor Cuomo has gone around touting what they've done. This is a state, obviously, Democratic legislature, Democratic governor, accomplished very substantial corporate tax reform. I think there are a lot of good examples of states that are doing it right, often on a revenue neutral basis or by reducing percentages of future growth rather than making substantial cuts. You can do that when there's revenue to do it or when you're willing to make the spending cuts, but the Kansas example tells you you have to know what you're getting into, and if you actually want to reduce revenues, you better have a spending program that goes along with it.
Are there others? Senator Donch?
Thank you, Mr. Chairman. Thank you, Jared. Would you, for me, please define a little bit better business inputs and give me some examples of what you mean by that?
Yes, sir. So a business input or a business-to-business transaction is basically any sort of intermediary purchase. It's not intended as a final consumption product, but rather it's something that goes into the production process. So for instance, raw materials, pretty much by definition, are business inputs. No one just buys raw materials to take home with them and have. You buy them so that you can manufacture something. And when you finish manufacturing that, you're going to sell it, and there will be a sales tax presumably on that final sale, but you don't put it on the raw materials, because if you put it on the raw materials, then you put it on, let's make it this is a sort of not very well integrated company. They buy the raw materials, they ship them off somewhere, and they pay someone to run them through various processes. So they pay sales tax on raw materials if you've got business inputs, then they pay it on some of the manufacturing processes. Then you have to package it, and you can pay on packaging, labeling, testing. All of these things theoretically could have a sales tax associated with them. And if you tax all of these things, the sales tax gets imposed many times, and sometimes it will be on a share of it, say like the cost of the packaging. Sometimes it can be on sort of an aggregate amount where you're even taxing a tax. But under either circumstance, you are essentially imposing the tax at multiple times across the production process. The extreme example of this is gross receipts taxes, where you're definitely taxing the tax because at every stage, you're taxing basically the entirety of what exists at that point. And this encourages you to vertically integrate as a company because you really don't want multiple ways exposed to that tax. A sales tax for business inputs is not that extreme because it can't tax all of the value every single time, but it can pyramid where when the final good or service is sold, embedded in the price before you even attach that sales tax at the end, you have portions of other inputs that were subject to tax. And ideally you wouldn't be doing that because when we think of sales taxes, the theoretical way we understand them generally is this is a tax on consumption. This is a tax on a final purchase, and therefore it should only be imposed at the end of the process. And there are transactions that can be business inputs or not, depending on who the purchaser is. So, if I'm purchasing something, example. Let's say accounting services, for instance. A business purchasing accounting services, arguably business input. Me purchasing tax preparation services, final consumer purchase. So there are some categories where you might make a very strong case for them being in the base for personal consumption, but it would not necessarily extend to they should be in the base for everything, because some of them would be business inputs by definition. States address this in a variety of ways, and they may address them in more ways going forward. One is that you can have purchaser-based exemptions. States already do this. For instance, nonprofit purchasers, by virtue of being a nonprofit, they don't pay sales taxes even when they buy things that are in the sales tax base. Often they have a certificate or they have some means of tracking. We don't pay sales tax. Sometimes we see other purchasers. A lot of states, especially those that are more ag-oriented, exempt all farm business inputs. And some things are easier than others. I mean, you don't buy $1 million combine unless you have a farm, but you might buy fertilizer just because you have a lawn. So how do you make these determinations? Feasible, things like that. So they do the same thing. A lot of them will have a number, a tracking number, or they'll have some sort of system where you have an identification as a farmer, and therefore when you buy all these things, they're not subject to tax. Other times they just sort of make a best guess, and it's not perfect, but you look down the list and you say, well, you know what, furniture, sure, there are some businesses buy furniture, but it's pretty close to personal consumption expenditure, and if the sofa in the office is taxed, maybe, this is margin of error, we can live with this sort of issue, that's probably not a disaster. So furnishings in the base, but, something that customized software out of the base, because while I might buy Microsoft Word and a business might buy Microsoft Word, I as a consumer will never have a company develop software for me. That just doesn't happen. So, we can sometimes just make these more generalized, stylized ideas of what's in and out of the base. This is obviously less accurate, but a lot of things in tax are based on a good enough system, and I think that in most categories, in many categories at least, you can make a reasonable guess as to who the purchaser is and have them in or out of the base based on sort of an 80-20 rule sort of thing.
Questions? Delegate House.
Thank you, Mr. Chairman. Thank you, Jared. Did you say earlier that the business inputs in these four models have been excluded? Is that correct?
Yes,
Okay.
that's correct.
All right, so that was my question. Thank you.
Other questions? One thing that, and Delegate Anderson is going to attend the meeting here, and I have staff members will do it as well. Are you familiar with the streamlined sales tax issue?
Yes, sir.
And I was just actually in Washington a week ago and spoke to one of our senators about it. He told me that he thought if it passed federally that the state of West Virginia might pick up about $100 million in sales tax. Do you all look at that? Do you know what might happen?
To clarify, Mr. Chairman, you're speaking more about remote transactions and not just the streamlined process. You're talking about like online sales?
Correct.
Okay. Revenue projections on this, there's really only one. There's a gentleman, professor in Tennessee, Bill Fox, who a number of years ago put together some revenue projections based on what he thought states might be able to expect. He didn't have a lot of data to work with. We've only seen one experiment with this since then. New York actually started taxing online transactions before the court struck it down. Their experience did not show the sort of revenue that was anticipated in his report. A lot of different theories as to why that was. It may be that initial estimates were overstated. It might have been that they had low compliance. It might have been that without the sort of federal backing, it was just hard to do. But the numbers were a lot lower. So that's the big caveat that no one really knows. And if you've seen numbers, they're all based on one report, and sometimes they're inflation adjusted or adjusted in different ways, but they're all based on one report, and there's a big question mark. There's certainly revenue, a decent amount of revenue associated with it. There are a number of bills out there. Jason Chaffetz has the Remote Transactions Parity Act that has a lot of support in Congress. I know that Chairman Goodlatte in House Judiciary does not favor that approach. He wants a hybrid origin approach. There's a deadlock at this point. I think it's a safe guess that within the next 5 or 10 years, we'll probably see something. I don't know what it'll be. I don't know if it'll be origin or destination based. I don't know what the parameters will be, but I do think this is the direction we're moving, and there will be revenues associated with that. And They could be somewhat substantial, but I would encourage a wait and see approach, because it's such a huge question mark, just how much is out there.
All right, that's good. So we won't hold our breath to get that revenue. Are there other questions of our presenter? If not, thank you very much. You're obviously a wealth of information, and there is conversation among some of our members about increasing our base and lowering our income tax rate as you addressed in those 3 states. So the information is very timely. Since there are no more questions, thank you very much, and I appreciate you being here. I think we have one more item. Won't take very long, and that is we have a subcommittee report. Our subcommittee dealing with the equipment and machinery, those taxes. Senator Gaunt, do you have a brief report for us?
Very brief, sir. Thank you, Mr. Chairman. On behalf of the senator or the delegate from Wood, yes, we met yesterday. It was an organizational meeting. We have an enthusiastic group. We
Anticipate that we will meet again in December prior to this committee's meeting and have a report and a recommendation, hopefully, for that meeting.
All right, thank you very much. Miscellaneous business, any other business come before the committee? Hearing none, I recognize the finance chairman of the House for a motion.
Yes, thank you, Mr. Chairman. Move that we adjourn.
Motion is we adjourn, all in favor say aye. Aye. Opposed, the same.